We start off with a big bond breakout. If you haven't been paying attention, yields went wild this week. The yield on the 10-year Treasury hitting a 4-month high. The Chartmaster called this rally earlier this week, and now he says it's got more room to run. Cornerstone Macros, Carter Braxton Worth is charting the action. Hey, Carter.
Hi. Well, it was a big week for rates, and obviously there are areas of the market that benefit from that, and of course, most notably, banks and other financials. But let's look at a handful of charts. The first I have here is the 10-year yield chart with the 150-day moving average. And what you see simply is that for the first time in almost 2 years, the moving average is flat and on the cusp of turning up. The point of using a moving average is like drawing trend lines. When you break above a trend, or you can measure it, and a moving average is an automated trend line, the change in trend is measured by the inflection point. And so we have that by all accounts here in 10-year yields. Now take a look at the second chart, which is the KRE. It's the same circumstance. The moving average is, having been declining for quite some time, is now flat and actually has inflected upward. Next chart, it's the BKX. It's the same circumstance. So the question, of course, is, do all turns persist? Could these fail and turn back? Sure. In fact, most had earnings last week, and they didn't do all that well. But the rate move has helped this area. We're thinking rates do go higher, and the financials as well, banks in particular. Final slide. This is just looking at where we are now in relation to the June high. So what we know, of course, is we're at about 165, and we went as high as 176. We think we're going to go as high as 176 for 30-year yields. For 10-year yields, we're sitting here at 85 basis points, and that June high, almost 1%. We think we're going there. Now, finally, look at the KRE and BKX that on the bottom of the table there. Were we simply to go back to where we were in the first week of June, you're looking at a pretty good move from here, roughly 10 to 12% in both the KRE and the BKX. So whether you call it cyclical or defensive, whether you call it growth or value, what we do know is that they're important turns, having been laggards, and a turn like this typically persists.
All right. Carter, thank you. We'll see you in a minute in options action. So what does this rise in rates we've seen for the week mean more broadly for the market? Steve, I'll go to you first. In general, rising rates, should be, in theory, a good thing. But in more recent history, it's been a bad thing for the markets.
Well, it's not a good thing for technology stocks. You never want to buy technology in a rising rate environment. You want to buy the cyclicals. You want to buy value. As Carter left it off, you can call it cyclicals. You can call it value. I call it value. And when you're looking at the presidential election, if you look at a Biden win, you could see where the polls started to increase for Biden. Then you started to see rates increase. That's the reflation trade. So if you started to see all these rumors, Melissa, about massive spending, it makes people get out of these bonds or these treasuries or 10-year. They sell them, and then what happens? The rates move higher from there. So you can't pass on costs in technology. That's why you don't want to be there. So you want to be in the things that have not worked, and that's why you've seen those things outperform. Chemical names, industrial names, paper stocks, all these names are up quickly 10, 20, 30, 40% in short order, and that's what we're witnessing now as rates move higher.
Jeff Mills, we see 1% as Carter is forecasting. What does the stock market do?
I think the stock market can hang in if we see 1%, but I'm in the camp where you see 1% and then you actually turn back the other way. I don't think the macro message from rates has really changed all that much. And I'll put on kind of my MIT nerd hat here for 1 second, so bear with me. But when you think about yields in the 10-year, for example, it's growth expectations plus inflation expectations plus the term premium. I think the move that we've seen so far is the term premium, because to Steve's point, what you're seeing is a really high correlation between a Democratic sweep and the 10-year Treasury yield. So I think the market is anticipating an increased supply, therefore the term premium has increased. It hasn't been growth expectations, it hasn't been inflation expectations, and I think the increase in the term premium is actually hard to sustain. Right now, Treasuries are at their cheapest relative to the yen and euro equivalents on an FX adjusted basis. So I think you have those investors come into U.S. government debt. It puts pressure on those longer term yields, flattens the curve. So I think that's the position we still might be in until we start to see those growth and inflation expectations reverse.
Well, until the point where it reverses, and assuming that it still goes higher, Delano, we've certainly seen the banks benefit. Would you be a buyer of the banks on this anticipated move even higher from where we are?
Yeah, I think, Melissa, that would be something that I want to take a second look at, because I've been pretty bullish. Steve mentioned I've been pretty bullish when it comes to the growth names, the tech names, and that's where we've heavily stood behind. But now it might be time to take a second look, especially at the regional banks. So as mentioned, when you're dealing with a steepening yield curve environment, those regional rates might see a push higher. And that's something we'd want to take a second look at. And also the bigger banks that will benefit from the steepening yield curve, as well as having strong divisions outside when it comes to their trading or their investment banking arms. So taking a second look at the banks is something I'm going to do, and it's primarily driven on if this trend can hold. And I think that's definitely what we're going to be looking for going forward.
Victoria, does the assumption, though, in terms of the economic backdrop have to be that the economy will, in fact, continue to improve? Or can we assume that rates will rise and we could be in this weird situation where, we're issuing a lot of debt because we are pumping the economy with stimulus because the economy has stumbled? And is that a decent backdrop still for banks?
Well, I think the immediate backdrop is going to be stimulus. I think that's been the catalyst to see the rates move up as much as they have over the last couple weeks. But when you look at those technicals, when you look at the range that the 10-year yield has been in during the pandemic, it's about a 40 basis point range. If you add that to where we are right now, you get to about 1.25%. I'm not sure we get quite that high. I think we get right around 1%. That's not going to be enough for the Federal Reserve to go in and change anything that they've been doing. So you're going to have low rates down at the zero on the short end. You're going to have that steeper curve. I think the Fed having the backstop and having additional stimulus come in, which right now it looks like it's going to be possibly a larger stimulus package after the election, that's going to be enough of a foundation to keep that long end going higher. As everyone has said, that's good for banks. But I also think it's good for the fixed income investors. They've been waiting for an opportunity to jump back in at higher yields in an area where they're not having to go down the credit curve to do so into junk bonds. This might give them the opportunity to do that.
Steve Grasso, what's good for the banks may not be good for consumers. And so the red hot housing trade, does that sort of come to a halt or at least come to a pause as we see rates move higher?
The 10-year on a yield basis increased by 44% from September. So it was just a month ago. And we've seen a stock like Lennar that I've been in and out of, that rallied 20%. So the short answer is I don't think it's going to kill the housing trade. Quite frankly, the dynamic of COVID is what's creating the housing boom. So there was limited supply, as you very well know, and everyone's moving out of city areas. Not enough housing out there. So I think there's multiple dynamics that have created the housing boom, but it's not singularly, say that twice, based on rates anymore. So I think that's and by the way, I'm going to start dropping that school too. I'm going to say, let me put on my MIT hat, but it's Jeff Mills's MIT hat from now.
You're going to say it, even though you have no ties to MIT.
It's just Jeff Mills. I'm going to put Jeff Mills' MIT hat on.
Oh, yeah.
What's the point of going there if I can't talk about it? Come on.
Yeah, I mean, it's
Perfect.
big price tag.
Shepard Smith here. Thanks for watching CNBC on YouTube.